This video is an introduction to order flow and order flow trading and is the first part of an ongoing series that will be a sort of order flow trading roadmap. So to start things off, use this video here to lay the groundwork, lay the foundations and explain what actually makes the market move based on order flow, which will lay, like I said, the framework and foundations for order flow trading as we progress through and get through to the more specific strategy stuff and using order flow tools in our day-to-day trading. So by the end of this video, you will number one, understand what order flow trading is and why it's beneficial, and number two, understand how to read the DOM, the depth of market, the price ladder. Okay, so we're going to dip our toes in that on this episode as well. A lot of my existing viewers are ICT traders or smart money concept traders, so this is a whole new world to you. So if you're coming along to this video with some previous trading experience or preconceived ideas about trading, I just ask that you come into this video with a clean slate, and what we'll do is we'll break down how the market actually moves based on facts. No conspiracy theories, no almighty algorithm, just pure facts on what moves the market and how the market moves. So let's get into it now and start with some very simple but wordy definitions. So order flow trading, what is order flow trading? Well, order flow trading is used to anticipate changes in price in the market by observing the flow of constantly changing orders of various sizes, which is your liquidity, and the aggressive trades, your market executions or the transactions, to view their impact on the market price. And then this analysis allows the trader to observe the balance between different market players as they buy and sell, and is the fundamental building block of market mechanics. Okay, so the key I like to highlight with order flow trading is that order flow trading is trading the right now. Okay, so order flow traders don't put too much importance on past information, historical price data. We're all about trading right now. What is happening right now? What is transacting right now, and how are participants coming in and out of the market right now? It's less of a predictive type of trading and more reactionary. We're not wanting to predict what will happen in the future, as traders aren't very good at that. Rather, we want to trade based on facts. What is happening right now? What data is occurring right now? If we were trading candlesticks, instead of speculating that, say we have some down bars here and then an up bar, and this creates an ICT order block and you're waiting for price to come up and retest, instead of speculating and say that, based on this candlestick pattern that we made here and then this upward candlestick pattern, I'm predicting price will come up and come down and retest this level and continue to the upside. There's too much prediction in that, okay? You're number one, predicting that price will come back down, and number two, predicting that price will then bounce from that level and go up. In candlestick trading, non-order flow styles of trading, there's a lot of predictive work there, which is just guesswork at the end of the day. Whereas with order flow trading, we are more working off what is happening right now and how can I benefit from it. So order flow itself, it's not a strategy in itself, okay? It's more of a language or a perspective upon which we will then build our trading strategies. Many different strategies you can use with order flow trading, but it's more a perspective or a language. We'll get into the specifics of this later. But for now, let's cover what is order flow and what is not order flow, okay? So order flow is not candlestick patterns, okay? You can't gauge order flow properly by looking at candlesticks. It is not arbitrary time frames, okay? We're not worried about which time frame, which chart, which 5-minute chart, 50-minute chart. We're not worried about that. That is irrelevant to order flow, okay? And last of all, it is not lagging indicators. No historical indicators at all are going to help determine order flow. So these things here, that is not order flow. It's historical data. It's guesswork. It's not what we're wanting to do. What is order flow? These are order flow tools that we'll get into in this series, starting with the depth of market, the DOM or the price ladder. This is order flow. The current order book, this is order flow. Liquidity charts, this is order flow. Time and sales, volume and volume profiles, market footprint, and delta. Okay, so these are all information that is happening right now and will help assist us with determining order flow and assist us in benefiting from reading the order flow of the markets. The only one that's a little bit historical is market footprint, but we'll get into that later. It's a very useful tool to use with order flow trading, so we will dig into that later on. But for now, what actually moves the market, boys and girls? Do you understand what moves the markets? ICT traders will say there's an almighty enigma, one single algorithm behind the scenes that is determining where price can go, because it's all rigged, it's all manipulated. Manipulation is true, but there is no almighty God algorithm that's telling you where price is going and where to deliver it to. It's the first thing we need to debunk, okay? So let's get into it. Here's a candlestick chart, for example. This is what you might be looking at if you trade candlesticks, and this represents any old market of your choice. And on a candlestick chart, it's taken into account time and price. So that's why price is moving to the right, because time's always going forward and price is always going up and down. So price is moving, and these candlesticks are printing based on an open high and low close of a arbitrary random time frame, 1 minute, 5 minute, whatever. Any time frame you pull up on any time frame will look identical to this. Okay, it's no different. This is what you're used to as a candlestick trader. Price is moving to the right and up or down, but you're not really seeing what's occurring in the market with this. You're just seeing, has price gone up, has it gone down, which is leaving a lot of information on the table. So let's discuss a better representation of how the market moves, and we'll get into the details. But this is where our friend the DOM, the depth of market, the price ladder comes in. Okay, this is a better visualization of the market, and the information you see occurring on the DOM here is what candlesticks are ultimately made up of. Okay, so what's happening here on the DOM is what's being transposed into candles, just minus a whole bunch of useful information. And you'll notice that on the DOM, there's no time frame. Okay, price is not moving to the right, it's simply moving up and down, which is what assets are doing all day long. During trading sessions, it's just moving up or it's moving down. There's no time frame on a DOM. We're trading the right now, right this moment. So first, let's look at the DOM here, and we'll discuss what we're looking at. Let me zoom in a bit. Let's discuss what we're looking at here, okay? It's quite simple to read. A lot of settings turned off, so I'm just looking at the bare basics on a DOM. We'll get into this in more detail in later episodes, but for now, let's see what we're looking at. So on a DOM here, your blue column is the bid. So everyone down here below current price is your current passive buyers. Okay, so these are limit orders on the bid. These are buyers waiting to line up and buy at these certain levels. Okay, and the number itself represents a contract, one contract. So this is the S&P 500, and each number represents one contract. So 62 means 62 contracts waiting there. The limit orders, buy orders, 62 of them are waiting at this level, for example. So these are all your buyers, your passive buyers. Vice versa on the other side, these are your passive sellers waiting to line up at certain price levels to sell. They have limit sell orders waiting to be executed at each level. Now, these limit orders don't move the market. Okay, they're just waiting for price to come to them, but they don't move the market per se. What actually moves the market is this one here. So in the middle, here we have your last traded quantity, and what this is market aggressors or market executions. Basically, people who are willing to cross the spread. Okay, now see, we have 13 buyers at 0.75, 46 sellers at 0.00. Now see, they're both at totally different prices, so price is not going to move unless a buyer is willing to cross over at that point, or if a seller is willing to cross over and sell to a lower price. That's the only way the market can move. If they just stayed on their side of the bid and the other sellers stayed at their side of the ask, the market would not move. So what actually moves the market is the market executions, the aggressors. So when someone is willing to, instead of buy at 0.75, they're willing to buy one tick higher, and if they buy enough contracts to consume this level of limit orders, that will push the market up. So you need at least 46 contracts at this point to cross the spread, lift the ask, and consume that number there for price to tick up, and vice versa for price to tick down. What we're seeing here in this middle column is that 25 contracts crossed the spread and sold to this level. So it's consumed 25 contracts from this price point, and there's only 13 remaining. So if another 13, or say even just 14 contracts crossed again at this moment and executed a sell order at this level, that would then consume this price, and then the market would tick down. So what ultimately moves price is when there are more market order buyers, okay, people willing to cross the spread and buy. When there are more market order buyers than there are market order sellers, and then there's those market order aggressors have to trade enough size to consume each level. Okay, 46, 55, 103, etc., etc. So let's look at this now. Say if we're using a candlestick chart, we see price moving, and then we have price make an impulse leg, right? A big, strong impulse leg. Maybe you'd call it a displacement leg, right? So this movement up here, the only way this impulse movement to the upside, a strong aggressive move like that, can happen, this is due to a large amount of buyers crossing the spread and executing at market at each level, consuming these passive sellers, consuming their levels, consuming their contracts, and continuing to hit over and over again. This can be algorithms, this can be retail traders, professional traders, large funds, you name it. As long as there are more aggressors crossing the spread, consuming these levels, that will cause price to move up. And price can only move up aggressively like this when the passive sellers thin out or move out the way. So what I mean by that is that these limit orders resting on the bid and the ask, they create floors and ceilings. Okay, so if you have a lot of people resting on the ask here, right, let's visualize it with a bubble. If you have a lot of people resting here on the ask and a lot of people resting here on the bid, and they're relatively equally balanced, the harder it is going to be for price to have an impulse leg. It's just going to trade back and forth between these two levels. As long as these levels keep replenishing, price is just going to consolidate back and forth, back and forth. You'll only have an impulse price leg when one side tires out and decides to move out the way. So say the sellers start to wear thin, they decide, okay, I no longer wish to sell at these levels. I'm going to remove my limit orders from the book. That then means there are less limit orders for buyers to consume, and market aggressors can then push the price upwards more aggressively to a higher level, and vice versa. So when we have those consolidation ranges that you see in price or on a candlestick, that's what's happening. When price is consolidating, it's simply because there is a larger presence or a balanced presence of limit orders on both sides of the book, restricting impulse movements. And as price churns at these consolidation levels, the traded volume is building up as people transact up, down, up, down, up, down. And think of it this way, both sellers and buyers are basically at an agreement. They're happy to buy and sell to each other at this specific level, and that two-way business can occur at this level. They're happy to go back and forth. So that's what's causing a consolidation. And when one side tires out, like we mentioned before, and price has that impulse leg swing away from this level, all price is doing is just looking for another level where buyers and sellers can then agree to trade upon again. So when the book thickens back up, and then we get that next consolidation range or the next move, and say this time the buyers tire out and sellers push price back down till we find another pocket. So that's effectively what's happening in the market every day. The price is just finding these levels of buyers and sellers agree and transact until one side gives up, then price swings to another level where buyers and sellers agree to move, and then price swings the other way, so on and so forth. That's what we're seeing happening on the DOM, and there are many ways to use this information to form a strategy around, or even just to inform your entries and exits better, okay? But we'll get into that in the next episode. In this episode, I just wanted to explain that, okay? So that's how the market moves, what causes it to tick up and tick down, and this is the tool we use to look at that information. It's the basic tool. It's a tool every order flow trader should learn first, learn how to read it, learn how to execute on it, etc. And what we'll do, we'll get a lot deeper into this in next week's episode and show you how to incorporate this into trading, some more practical uses. And I'll also run through some drills. So when I first started learning the DOM, I learned some drills I could use to practice using the DOM, learn what to look for, learn different setups to use on the DOM, and just how to get comfortable with executing using this. Okay, so get away from executing on charts and start to execute using the price ladder instead, and learn to read it properly. So I'll run through those drills on next week's episode, and we'll get into depth on how to use this with a practical application. It'll be the first thing to learn with order flow trading. So if you like the video, make sure you subscribe, hit the thumbs up button. Next episode comes same day next week. Comment below if you enjoyed this explainer, this intro video. Again, keeping it nice and light to start things off. We'll get into the nitty gritty starting next week. And if you can't wait till next week, I do trade live every single day as well, using the price ladder, using order flow techniques. Trade live every single day for free here on YouTube at 2:30 p.m. Eastern time, just before power hour at the end of the day. And I trade that through to market close. So check that out under the live tab on my channel. Otherwise, I will see you guys next week.